Chapter 2 of Financial Management. It is working with financial statements. So in this chapter we have three learning outcomes. Number one is using financial ratios to evaluate the financial health of companies. Number two is apply DuPont analysis. And number three is explain the limitation of ratio analysis. Using financial ratios to evaluate financial health of companies. So now the question arises that why we use or why the company uses financial ratios. Financial ratios are normally used to evaluate the performance of the company, and there is a lot to be said for valuing a company, and it is no easy task. So if you have yet to discover this gold mine, the satisfaction one gets from tearing apart a company's financial statements and analyzing it on a whole different level, uh, and especially if you or a company wants to save money. So in this section we will explain you about the financial ratios and what are the purpose of financial ratios. In this slide you can see that the purpose of ratio is to express accounting numbers in a relative sense. So sometimes just looking at a profit and saying, okay, we have a profit of $100,000, what does it actually means? A layman cannot judge on the basis of just profit or on the basis of just sale. So a layman, or you can say a stakeholder, needs a clear and easy picture for themselves to evaluate the performance of a company. And how they can compare these ratios, they can compare with themselves as well, means they can compare the ratios with the company's previous performance, plus they can compare with other firms, or you can say with their other competitors. These are the samples of SIC code. SIC code means Standard Industrial Classification. Basically, Standard Industrial Classification is a series of 4-digit codes created by US government in 1937 for categorizing business activities. So if we are on a retail trade, so our code would be 54. So these codes are created for trading purposes, um, for custom purpose, so it can be used for different purposes. In this slide, we will discuss that who are the users who actually uses the financial ratio analysis and why. Number one comes creditors. Uh, should we make a loan? Okay, who are creditors? Creditors are the one who gives something to the company. For example, commercial banks. Banks are the one who provide loan to the companies, so they are creditors. So their main question would be that should we make a loan or not? Because if the company's performance is not good, so obviously the bank would hesitate in giving loan to them. Second comes investors. Should I invest? Now suppose you wanted to invest in a certain company. So your first question would be that should I invest or not? And how you will judge them? You will judge them by checking and by evaluating their past performance and current performance. And how you can judge their performance, the best and the easiest method is ratio analysis. Number third comes shareholders. Who are shareholders? Shareholders are the one who have actually invested, who have already invested in that company, and now they have to check that whether their investment is going on the right way or not. So their question would be, how is management doing? If the performance of the company is good, it means, or it shows that yes, the management is doing, or the management is going on a right direction. Number fourth comes the regulators. Regulators are the one who actually control or who actually implement the law on the companies. For example, stock exchange, they are the regulators. Every country have different stock and exchange commission. They are the one who are the regulators. So you can say the taxation department is also a regulator. So their question would be, should we mess with them? So if they check with their ratio analysis that there is something fishy, then obviously they should audit that company. Otherwise, they say okay, they are going in a good direction. Number fifth comes managers. Now, who are the managers? Managers are the one who actually managing the company. Uh, for example, directors, they are managers of the company. Manager does not actually means only the manager, it means employees of the company who are managing the company on behalf of shareholders. So their question would be, are we not great? It means that if they are performing well, they can ask the question that yes, we are doing good. And if the company is going in a bad shape, then obviously they have to work more hard to get the company in a good position. So let's go to the other slide now. Analyzing financial performance using ratio analysis. So these are five types of ratios that we normally use, and then in each ratios we have different sub ratios again to calculate. Number one is liquidity ratios, number two activity ratios, debt ratios, profitability ratios, and market ratios. So all these five ratios are meant to be target for different customers and for different users. Like liquidity ratios is normally used for shareholders and for creditors because it measures a firm's ability to satisfy its short-term obligation as they come due. So basically liquidity ratios tells us that how much cash do we have so that we can satisfy our short-term obligations. Like we have $100,000 loan coming in coming within a year. So we have to check that whether we have sufficient cash available or not. Number two comes activity ratios. It actually measures the speed at which firm converts various accounts into sales or cash. For example, a company is selling toys. So toys are inventories for that company, and the speed, or you can say the time at which the companies sell those products the are measured by activity ratios. Number third comes debt ratios. Debt ratios are normally used by creditors because the creditors have to check that what is the current debt ratio of the company. If it is high, so the bank will not give them loan. If it is low, the bank will give them loan. So it measures the proportion of total assets financed by firms' creditors. Because normally the loan which the bank gives to the company, it is financed by one of the company's asset. Number fourth comes profitability ratios. Now this is the ratio which is normally used by normal laymen or by shareholders because it actually tells the firm's earnings and or how much profit the firm is generating. Number fifth is market ratios. Market ratios are normally checked by the account holders and the shareholders, because it is the most common ratio that is used in stock exchange. If you hold a share of a company and you wanted to sell it off, you go to the stock exchange. So if the market ratio of the company is good, then you can sell it in a high price, otherwise vice versa. So these were the ratios that we are going to study in detail in the upcoming slides. Let's discuss the first ratio, that is liquidity ratios. In the previous slide, we have already told you that liquidity ratios measures a firm's ability to satisfy its short-term obligations as they come due. So, how do we measure liquidity? It is by comparing cash and other assets. What are the other assets expected to be converted within the year? Now, what are the assets which are expected to be converted within the year? Those are known as current assets. So current assets includes inventories, it includes receivables, it includes your bank cash, it includes your cash in hand. So all these are current assets, because current assets are the one which can be easily converted into cash in a short period of time. What is the short period of time? We termed it as a 1 year. So this ratio is a comparison between the current asset and the current liabilities. And under the liquidity ratios, there are two types of ratios. One is current ratio and the second is quick ratio, also known as acid test. So in current ratio, what we do, we just divide current asset by the current liability and it shows us the current ratios. Now what comes under current asset, I have already told you that under current asset you have inventories, you have receivables, you have cash in hand, you have cash at bank, and any other asset which can be converted into cash within a 1 year. What comes under current liability? Now in current liabilities you have payables, you have short-term loan which you have to pay within a 1 year of span. You have to it comes creditors that you have to pay within a 1 year. So all those payment which you have to pay within a 1 year of time are known as current liability. So when you divide current asset by current liability, it comes current ratio. So, and please note that if you have high current ratio, it means you have a good liquidity position. But if you have a low current ratio, it means you have a bad liquidity position. Number second ratio of the liquidity is quick ratio. What we do, it is same like current ratio, but we subtract inventory from current asset, because inventory are the one we actually sell for our business, and so that's why we exclude it from the current asset. So it would be current asset minus inventory divided by whole current liability. And if you wanted to analysis of this ratio, if you wanted to analyze this ratio, then it is the same, that if it is higher in value, it means good. If it is lower in value, it means bad. So this is the example of measuring the liquidity of a company. In the previous slide, we have shown you that current ratio is equal to current asset divided by current liability, and quick ratio is current asset minus inventory divided by current liability. So this is just an example. So critical thought question: Now these are two questions which normally students ask and which can become into exam. Number one is, when would we want to use the quick ratio instead of current ratio? Okay. As I have told you before that the difference between the quick ratio and current ratio is inventory. We all know what is inventory. Inventories are our product, or you can say inventories are our current asset that we have to sell. So how much time will it take to sell? That is a question mark. So that is why we normally exclude inventories from quick ratio. Normally, if a company is service based, they use current ratio rather than quick ratio, because they have a very minimum amount of inventories, so it doesn't matter how much they have. But if a company is a manufacturing company, then obviously their main product is inventory. So to evaluate the exact figure of the company or the exact liquidity position of the company, they use the current ratio, quick ratio instead of current ratio. And the second question comes that, should the current and quick ratios be as high as possible? The answer is yes, because if you divide current asset by current liability, the higher the amount, it means you have more assets as compared to current liabilities. So this is the same case for both ratios. So it is always good to have high ratio as much as possible. The second ratio comes debt ratio. You can also say long-term solvency measure for debt ratio. Assets of the firm are financed by debt. Now what is debt? We have already told you that it is capital received from creditors. Who are creditors? Creditors are normally banks. And equity. Equity is capital received from stockholders or shareholders. How? Suppose I sell my shares or I purchase company's share, that amount will go to the company's equity. Now the relative percentage of the firm's assets that are financed by these sources are indicated by total debt ratio, which has a long-term focus. Okay, now there are two types of things which we have discussed. Number one is debt and number two is equity. Now when we check the relative percentage of debt and equity, that how much the amount is financed by debt and how much of amount is financed by equity, that ratio is actually called the debt ratio. Okay. The time interest earned. Now this is one of the type of the ratio which we calculate. Number one was debt ratio. Debt ratio is equal to total debt versus total assets. Now number two is number two is time interest earned. Now what is time interest earned ratio? It is a ratio that tells us the interest in determining the firm's ability to make the interest payment on its debt. This has a short-term focus. Okay. Now this is the time which is taken for interest to be determined in firm's ability. What does it mean? It means that for every long-term debt, we have to pay them back in an installment. Now what type of installment? These installment are short-term installment. We pay back debt in terms of interest. So the time which we take in giving back that interest is our time interest earned. How we calculate? We calculate by dividing the interest expense by operation income. So it would be EBIT. EBIT is earnings before interest and tax divided by interest expense. The third type of ratio is cash coverage. What is it means? It is the ratio recognizes that depreciation expense is a non-cash deduction and does not hinder the firm's ability to pay interest. It is almost same like time interest earned ratio, but the only difference is that we add depreciation expense on EBIT, on earning before interest and tax. Why we add? Because depreciation is a non-cash item. What is depreciation? Let me give you an example. Suppose you have purchased a car today worth $1 million. After 1 year, the value of the car would not be 1 million. It will depreciate. Why it will depreciate? Due to wear and tear. It will depreciate to $900,000. So it means $100,000 is actually depreciation. But it is not physically present. It is not present in the form of cash. But yes, it is an expense. So for cash coverage, we add depreciation expense from EBIT and then divide it whole by interest expense. So this is just an example of debt ratios. You can calculate it yourself. Just you have to remember these three formulas in calculating all these ratios. Number one is debt ratio, number two is time interest earned ratio, and number three is cash coverage ratio. So these are three ratios which comes under debt ratio. In the previous example, in the previous slide, we have seen that there are 5 types of ratios. One is liquidity ratio, the other is activity ratio, third is debt ratio, fourth is profitability ratio, and fifth is market ratio. We have already studied two ratios. Number one was liquidity ratio, and then we have studied debt ratio. Now this third is activity ratio. It is also known as asset management or turnover measure. Why it is known as asset management? Because activity ratios tells us the speed at which firms convert various accounts into sales or cash. So it actually means how we manage assets to convert it into sales. So it is known as asset management. So this approach examines the firm's ability to convert account receivable, inventory. What are these? These are actually assets. So this approach examines the firm's ability to convert assets into cash on a timely basis. And there are 5 types of sub-ratios which we use to calculate the activity ratio. One is average collection period, second is receivables turnover, third is inventory turnover, fourth is days sales in inventory, and the fifth is days sales in receivables.